Hi, this is Hutch with Life-Insurance101.com, and today we're going to discuss famous entrepreneurs and their life insurance. We're going to see how life insurance either helped to start their business, grow their business, or save their business. And we're going to see if it's still a valuable tool today. We're going to see how life insurance can help protect your biggest asset, your human capital, how it's a better bucket for safe money, and how it's accessible for emergency or opportunity. I like this article on Disneyland history by Betsy Malloy because it documents some of Walt's early struggles. And I especially like that it's quoted directly from the Disneyland News Media sourcebook. And in fact, one of the early architects, John Hench, is quoted as saying, "I remember several Sundays seeing Walt across the street in a weed-filled lot, standing, visualizing all by himself. And there he is on opening day up in the corner there long after the dream was realized." Early on, however, Disney said, "I could never convince the financiers that Disneyland was feasible because dreams offer too little collateral." And isn't that always the case for early entrepreneurs? Undeterred, he borrowed against his life insurance and sold his second house just to develop his idea to the point where he could show others what he had in mind. So when his bankers and even his employees probably thought he was a quack, it was that guaranteed access to liquidity that his life insurance provided, which allowed Walt Disney to create a legacy far greater than rate of return. This article by Brian Anderson talks about a food industry salesman who stumbled upon two brothers with the winning business model, but knew that he could make it bigger and better than just a simple hamburger shack. So Ray Kroc, 52 at the time, decided his future was in hamburgers and partnered with the brothers. He opened his first McDonald's in Des Plaines, Illinois in 1955 and bought out the McDonald brothers in 1961. Any business owner will tell you that the startup process is far from glamorous, not to mention after you lost two key partners to help absorb the burden. So the article goes on to say, Ray Kroc did not take a salary during his first 8 years, and to overcome constant cash flow problems, Kroc borrowed money from two cash value life insurance policies, and also his bank, to help cover the salaries of key employees. He also used some of the money to create an advertising campaign around emerging mascot Ronald McDonald. So Bob Hope once said, "A bank is a place that will lend you money if you can prove that you don't need it." I see this with a lot of my business owner clients where the bank is only comfortable lending up to a certain point. Even successful operations are forced to rely on their own funding to take it to the next level or to sustain hard times. And if they have this unfettered access to capital, entrepreneurs can enjoy astronomical growth curves within their own business where they have more knowledge and control. So let's take a look at Mr. JCPenney, compliments of Wikipedia, and we're going to take a look at their explosive early growth. So the Penney stores expanded nationwide with 120 stores in 1920. By 1924, Penney's reported income of more than $1 million annually. It's a lot of money back then. The number of stores reached 1,400 by 1929. Penney's large income allowed him to take some winnings off the table and invest in a lot of different things. It says here how Penney and his partner invested heavily in Florida real estate, and this may sound somewhat reminiscent of a more recent time because, unfortunately, Penney had also been putting money in a vast stock portfolio before the whole bubble popped. Stocks crashed, property values plummeted, and banks failed. Interestingly enough, no life insurance companies failed because their reserve requirements are much stricter than banks. Whereas banks can loan $10 for every one on reserves, life insurance companies are mandated to keep over $1 for every dollar of liabilities they have. So after James Cash Penney lost virtually all his personal wealth, he borrowed against his life insurance policies to help the company meet its payroll. So when everything around him came crashing down, JCPenney was able to access capital using his life insurance to keep his most valuable asset alive, his business. Simply having guaranteed growth and access to equity with no questions asked allowed him to pull his business out of the global tailspin at the time and last for generations thereafter. Speaking of generations, our last example is a fourth-generation family chicken farm, Foster Farms. Many of you on the West Coast will immediately recognize the brand, and this story comes straight from their website. A young couple named Max and Verda Foster started Foster Farms in 1939 by borrowing $1,000 against a life insurance policy. So look at these two, and think of them saving every penny between 1929 and 1939. They invested in an 80-acre farm near Modesto, California, and began raising turkeys. In the beginning, Max worked at the Modesto newspaper to help support their young business, while Verda concentrated on raising the healthy chicks. Soon after, Max was able to leave his job at the newspaper to focus full-time on their growing poultry farm. So here's an everyday, hard-working couple who probably after the banking collapse decided to save their pennies in life insurance, only to find the economy still in shambles 10 years later. And when cash is king, opportunities will seek you out. Using their life insurance, they were able to invest in themselves and parlay their hard work into an ongoing family fortune. So you might be asking yourself, why did all these famous entrepreneurs use life insurance as their parking lot for safe money? And it's the same reason banks park their Tier 1 capital in life insurance. Better opportunities for growth, rates of return that don't start with a dot, tax shelter growth, and access. Creditor protection in many states, not all of them, but a lot of them have creditor protection, and last, the death benefit and a myriad of other benefits. Some contracts have long-term care or chronic illness riders, some have disability riders, some have guaranteed retirement income riders. Regardless of the bells and whistles of any particular product, you can see how $1 wears multiple hats in a well-structured life insurance policy, and how it provided these iconic entrepreneurs safety and liquidity of their capital when they needed it the most.